Welcome everyone to the Fiscal Philosophy YouTube channel and Happy New Year. Realty Income, they crashed hard in 2023, at one point getting below $50 per share. They have not yet recovered to previous levels. Will 2024 be better for Realty Income? I'm going to give you a little bit of insight onto why it is I think that their price dipped so hard, why it's recovered some, and where it may be heading in 2024. I do own some Realty Income. Just because I own it doesn't necessarily mean it's the right fit for you, but here we go. Realty Income is, of course, for the uninitiated, the REIT that actually went as far as to trademark themselves as the monthly dividend company. That's how much they care about providing that consistent monthly cash flow to their shareholders. Now, in addition to paying out monthly, they also are known for their streak of dividend increases. In fact, they are one of the coveted dividend aristocrats, and in most years, they actually increase their dividend multiple times per year. Recently, they haven't been amazingly high increases, but nonetheless, they can provide a growing stream of monthly income to their shareholders. Client concentration is one of the biggest risks facing different REITs, and Realty Income mitigates this by spreading the risk across many different highly creditworthy clients in a lot of different industries, including retail, restaurants, gyms, and movie theaters. They also spread their geographic concentration across many different states domestically in the US, as well as internationally, with over 12% of their portfolio being in the United Kingdom, and no more than 10.1% in their largest US state being Texas. When it comes to valuing Realty Income, my personal interest was highest, of course, right near the $50 mark, and when it was lower, of course. Now, that's because it was approaching trading for just its straight up book value. Realty Income normally trades at a premium to their book value of anywhere from like 40 to 50%. You can see, if you look at the price chart, that there were periods of time where it was trading in the mid to upper 60s, and that was pretty normal when interest rates were, kind of at their lowest point. Now we have a time where interest rates went up and money funneled sort of out of these consistent dividend payers like Realty Income into more secure investments like, treasuries and things like that, bonds, which pay out but don't have as much risk as stock. As of the most recent price recovery, the yield is just over 5%. The reason for the price drop to begin with is because as interest rates rose and you could get, 5+% on 90-day treasuries, or, 4.5% in a high yield savings account, a lot of people sitting there with money thought to themselves, why stay in a stock that could have, potentially some kind of risk of a dividend cut? Granted, with Realty Income, that risk is rather low, but it's even lower in terms of bonds and high yield savings accounts. So moving forward to the 2024 outlook, because I think that's what ultimately everybody wants at this point. Off the bat, I think with the information we have today, the idea of Realty Income going down back into the 40s is probably relatively unlikely, unless the Fed, again, changes course and decides not to lower interest rates, or decides to start raising them again for some reason, or something very strange and catastrophic happens that causes a couple of Realty Income's major tenants to go under and stop paying rent, something like that. I do think what's most likely is, as interest rates fall, you'll see marginal increases in Realty Income's share price, as the yield has less to compete with in terms of bond yields and high yield savings account percentages. So I think if interest rates continue to fall and get close to zero again, we could see a situation where this gets back to the mid to high 60s at the very least. One area I would potentially change for Realty Income is I would like to see them slow down on the debt a little bit, or maybe even pay some of it down. Interest rates impacted REITs for two big reasons. One, of course, is it made their yields less competitive. Real estate investment trusts usually have some of the highest yields in the market, and those yields become less competitive if bond yields and treasury yields go up. Also, though, the debt is seen as a higher risk during times of higher interest because the payment for interest when they refinance this debt would, of course, go up if they have to refinance it at a higher interest rate than when they originally borrowed. So I think that they would have less exposure if they were to pay some of this down going forward. That being said, I think the issue with debt is probably, in the grand scheme of things, a pretty minor concern for Realty Income. The management here definitely knows what they're doing. They've maintained, for the duration, a consistent 98% plus occupancy rate, which anyone who's ever been actually involved in directly managing real estate, you know how difficult it is to achieve occupancy rates this high. So clearly they're doing something right. And I certainly would probably, if the stock did happen to drop back into the 40s again, which again I said is a fairly unlikely scenario for the next year, I would more than likely be looking to actually double my position, depending on what factors were at play, whether it was for legitimate reasons or just because of some temporary turbulence or fear surrounding REITs like what we had this last year. When it comes to the valuation of Realty Income, I get the general sense that it's probably approaching value territory at a below 1.2 price to book value, with below a 1.1 certainly being in the range where I'm definitely starting to get interested. It's possible also to look at this from a price to funds from operations perspective if you so wish. I'm personally just using price to book because it's pretty readily available on almost every data feed, so it's easy to monitor and watch out for and track over time. So, my general sense for how 2024 is going to go for Realty Income is, if the Fed goes through with the proposed 3 rate cuts, as the yield on bonds starts to go down and suddenly you can't get 5-6% whatever on a lot of low risk bonds, you can't get 4.5% in high yield savings anymore. I think a lot of people will start to move out of bonds, cash equivalents, and high yield savings, and you'll see some money start to flow back into REITs like Realty Income. I think that their monthly growing dividend will start to look more and more competitive and attractive as those rates come down, and the debt will look like less of a risk, less of a drawback, what have you. And I think, you'll see probably a slight appreciation in the share price, maybe back into the low or mid 60s is possibly doable, possibly even as high as the upper 60s, depending on how sharply the Fed actually cuts those rates. That remains yet to be seen. So, in conclusion, I'm glad I picked up some Realty Income while it was pretty cheap this year, and if it goes the other way and somehow declines in price again, I might be looking to pick up some more. I would like to offer my appreciation for making it to the end of the video. Please follow me on X/Twitter at Mr. Macho Mog, link is in the description. Also join my Discord, link in the description. Catch me every Saturday night, 8 p.m. Eastern on Cashflow Kings Live, link in the description there too. Join my channel, become a member, support me financially. You'll have my eternal gratitude. Thanks everyone, take it easy.